Hello and welcome to my morning note. Obviously markets have been extremely scary of late. Stock markets are falling, bond prices are rising, bond yields are falling to historic lows, and plainly that shows both that there's a lot of fear around and also that there's very great pessimism about the economy. But does it also suggest that there could be a very big buying opportunity in stocks or perhaps a selling opportunity in bonds? There are many arguments about how those two asset classes should relate, but it is very interesting to see exactly how strongly bonds have outperformed stocks over the last few years. It's very unusual. So, is this the time to buy stocks against bonds, to buy stocks or to sell bonds? With me now to discuss this is the head of Wadhwani Asset Management and a former member of the Bank of England's MPC, Sushil Wadhwani. Sushil, thank you very much for being here today. Now, the critical measure in which these two asset classes often are compared is the equity risk premium. We've got a chart which you prepared for us here. Broadly speaking, the equity risk premium is the extra return people expect to take on the extra risk of stocks rather than bonds. Can you take us through how you prepared this chart, what the assumptions are, and what it tells us?
Essentially, what you find is that currently the equity risk premium has reached a 25-year high. Now, historically, extremes in this measure have been quite a good medium-term guide, and I emphasize medium-term guide to where equities go relative to bonds. So the last time I got particularly excited about this was in '99.
Which was a good time to get excited.
Yes, and essentially bonds then, over the subsequent decade, obviously, as you already pointed out, meaningfully outperformed. I was also reasonably excited about things in '87, which was another point where essentially equities got very overvalued relative to bonds.
We're assuming here future growth rates. Yes. What is the assumption in that low growth green line that sinisterly appears at the right of the chart?
Yes. Essentially, unsurprisingly, I've encountered quite a lot of skepticism about this calculation, and people say to me that I'm being too optimistic about growth by using consensus-like estimates for growth. So we only took 1/5 the number of the consensus expectation for earnings growth.
So it's a very drastic haircut.
Yeah, drastic haircut. And then over the subsequent period from 4 years to infinity, we essentially assumed only a 25% reduction, so a more modest reduction. But even if you do that, you end up by saying that equities are still somewhat undervalued relative to bonds and should be expected to outperform over the coming decade.
Now, this is all relative. Let's take a look at another chart, because I suppose the question would be, is it really that stocks are very cheap, or is it that bonds, for all the reasons we've discussed, are just historically unsustainably expensive? What are the chances that bond yields stay at the kind of rates we're currently seeing?
Yes. Now, essentially, if you look back over the last 40 years or so, it is historically unusual to have negative real long-term interest rates for very long. However, if you go back further, there have been more prolonged episodes, one soon after World War I, and then a much more prolonged period between 1942 and the early 50s, when the US Federal Reserve was explicitly capping bond yields. So they were interfering in the market just as they are now with their policy of quantitative easing.
So if the interference carries on, could we continue to have what appears to be a very generous equity risk premium for a long time?
Yes. The Fed is saying kind that it might start normalizing interest rates at the end of 2014, early 2015, and then it's going to gradually raise rates to some number like 4%. Now, if you believe that, then bonds are massively overvalued. However, if the Fed is being too optimistic, then indeed it may engage in QE for longer than it's currently saying, and then bond yields can remain depressed for longer.
But in a curious kind of way, there's this old market cliche that you should never bet against the Fed. To some extent, if you're buying bonds at the moment, you're almost betting against the Fed's forecast.
Oh yes, absolutely. And buying bonds is quite risky because essentially what you're doing is you've got a negative real yield and you're betting implicitly on continued capital gains. This is what happens in all bubbles. It's worked until now,
Right.
but at some point the music will stop and the capital gains will be replaced by capital losses. And at that point, there'll be a scramble for the exit, and you could get a huge repricing in the bond market very quickly.
Okay, Sushil, thank you very much indeed. This isn't exactly a positive conspectus. Make it very clear that we're only talking in the medium term here. This isn't a prediction for what's going to happen next week, but in the medium term, it does look like a very good bet indeed that stocks will outperform bonds.